Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. Today's show, I'm going to provide a market update with returns to the end of March. You can also find these graphs on my blog post in the usual spot. As a brief legal disclaimer, my discussions here should not be construed as financial or investment advice, and each person's situation is unique. All right, let's go. So last month, the readers and listeners may recall that I was clarifying that returns last month were through the end of February, and it did not include the start of the Iran war, which was on February 28th. Well, this month, we're going to see the impact of that. Definitely came through very strongly. So here we are. And definitely past summaries, it was always, typical broken record. Equity markets up, international markets ripping like hell, bonds and credit spread tight, usual, everything is fine and dandy. Well, this month that definitely changed. And so you'll see on the graph on the screen now, you'll see the summary of our major asset classes. And the one thing you'll notice right away, a bunch of negatives. And so, in fact, you have to go all the way down. There are two asset classes that are positive. One is commodities, which I'll talk about in a second. That's going to be energy. And the other one is actually Bitcoin. You may be kind of surprised. I was surprised by that, but I'll talk about that in a bit more detail in our detailed graphs. So looking at the table here, again, very different story this time. Everything is negative. U.S. large and small down about 5% for the month alone of March. That brought large caps to negative roughly 4.5, 4.3, I guess, for the year to date. But small caps, which were outperforming and still are, they're holding on to a small gain year to date. The big negative side, though, again, last 15 months or so, international markets were just ripping. So this time they're down as well, but down almost double the amount as U.S. equities. So specifically, we got 10.3 minus for the developed markets and minus 13.1, let's call it, for emerging. And so two reasons there. One, again, the Iran war, the energy prices are skyrocketing. So all countries and companies are exposed to that, but European countries more so than the U.S. We're a bit more insulated with our energy production that we have, although we're exposed to it. They're definitely much more so. Then the other thing to keep in mind is with international equities, and this is a bit wonky, but I'll give you a 1-minute summary or 30-second summary. Strength in U.S. dollar also caused the returns in U.S. terms to be lower. Briefly, the reason for that, think of it as when you show international returns in U.S. dollars, the first thing you have to do is convert it back to the U.S. dollar and then show the return. So if you do an example, if international equities did not change at all, they were just flat for the month, but the dollar strengthened, it's going to take more of those dollars in international currency to buy the U.S. dollar. And so by definition, it's like, oh crap, the same return or same dollar amount here, but it's going to take more of it to buy the U.S. dollar back. That's why it was a big headwind in the past, causing returns to be higher in the international markets because of a weakening dollar. Now we're seeing the opposite effect of that. I don't have the breakout of what that percentage is, but it's definitely one of the two drivers. On the treasury bond side, and this is another kind of a surprise for me, you would think, hey, we're going to war, the flight to safety, U.S. treasuries will bid up, bid prices up, yields down. That's not the case. If you look at the table here, even the short term, even the 1 to 3 years. So all treasury bond maturity levels have a negative return for the month. So again, normally you'd have that flight to safety, but because of higher energy prices, that means higher inflation. And so you're going to have the power of the impact, I should say, concerns about higher inflation dominated the normal flight to safety that you would have seen in times of stress like this. We'll talk about the Federal Reserve and the Fed funds rate and what that means, which is why also the short end is down in price, up in yield as well. Corporate bonds, I'll talk about later. And then again, I said there were two asset classes that were positive. So commodities. So yes, energy is a piece of that. A quick clarity, the commodity index I show on the graph on the screen here is the Dow Jones or the Bloomberg, whatever one they call it now, but it's capped at around 30 or 33% energy, whereas some people may be familiar with the GSCI commodity index. That one is closer to I think it's like 50 or 60% energy. Anyway, this is the more diversified commodity index with a big chunk of energy. It is up 11.5 for the month alone, and on a year-to-date basis, 24.4. So definitely running very strongly. Energy there. Again, kind of that flight to safety. It's like, oh, gold must be adding to it as well. Not the case. Normally you would think, again, in times of stress, gold being up, but it's not. It's actually down. Part of that is just, or a lot of it is just and people taking the gains. And so there was we call it a very strong run late last, or all of last year, I should say, into early part of this year. And so it's just profit taking on the gold side. And then of course, Bitcoin on the month, that is a correct reading, is up 3.3%. And so I'm going to talk a bit more about it later of what it's done and when it happened, but it is a up market for Bitcoin, and that is a correct number. So that is a quick summary of the table. Now you'll see on the screen is the graph of our ETFs, again, capturing the major asset classes. This is now a true year to date. So in the past, just given the short time of the months, we were showing 13, 14 months. So this is just a true 3-month year-to-date graph for these major asset classes. And I guess before I comment on a few of the major asset class moves, one thing to point out, since it's only 3 months, you can see the move. The last day of March, there was a pretty big rally in equity markets here. For you careful readers, I was a little surprised by this, but I realized, oh yeah. So I just finished talking about the table up above, and the year-to-date returns for international equities in particular were both negative, minus 1.2 developed and minus 0.17 for emerging. Yet on the graph down here, I'm showing positive year-to-date. So what the hell's going on? All correct numbers. The key is what I'm showing you here are ETFs, which are traded in the U.S. market. So again, there was a big rally. Main driver was President Trump announced that, again, I believe it was part of a negotiating ploy, not direct expectations, but part of his, in my opinion, his negotiating strategy was, I don't need to have the Strait of Hormuz opened to end this war. So the market definitely jumped onto that. Markets rallied quite a bit, but the ETF market was open in the U.S., which captured the rally in the international equity markets. And so it shows positive year-to-date here, and that's why it's negative up on the table above, because that's an index, and the markets were closed at end of the month. Way too deep there. Let me back out and go back to our graph. Oh, usual suspects on the graph here. For the first 3 months here of the year, the big positive, that green line, is commodities. That's up 28%. Again, I mentioned that is energy. If you look at the big run from March on, almost all energy driven. You can see the spike before that into January. That would have been the precious metal driver there. So that's what's driving the big winner there. Emerging markets, that's the magenta line. So that was the leader, maybe not quite at the end of last month. It looks like it would have gotten beat by commodities a little bit. But anyway, it had a very strong start to the year. It's now up 3.8% for the year, but it was actually the day before month end, it was touching and even hitting negative territory year to date. So big pullback there on the magenta line. The other surprising thing is, large caps, U.S. large cap equities. Usually they are at the top of the pack for the last X years. This particular year-to-date graph now, they are the lowest. So minus 4.37% for the U.S. large caps. And then finally, I guess just for bonds. And so I'm not sure what the color is here, if it's brown or orange, but the 0.03, so basically flat for the year. Again, remember, this is a total return chart. So it includes both dividend income and price change. And so what that's telling you is you had 3 months of income for your bonds, which is good. It was positive, 1 and change, but price change took away that with the higher rates, lower price caused a negative, I guess slightly positive year to date, but took away the returns. So that is the quick summary of the major ETFs for the first 3 months of the year. This month, I decided to show that my focus graph this month is more of just some of the unique movers relative to the S&P 500, similar to last month, but a little bit of different theme here. So the graph we're showing on the screen now shows, again, the same ETFs, chosen ETFs, and the same 3-month history. The frame of reference here, our anchor point, is going to be that purple line. That's the S&P 500. Again, minus 4.37 year to date. That's our reference point. That's what the U.S. market did year to date. So then the first thing I want to point out, I show the growth versus value. So looking at the colors, I guess it's orange and light blue. Value has been outperforming growth year to date, and you can see that on the graph there. But again, pronounced in March for the growth. And so there's a bigger pullback there. Yes, value is down as well, but that is hanging on to a positive 3.3. So again, growth versus value story. We got a 13-14% deviation with value up 3.3 year to date, growth down 10.4. The next line, or the next thing I want to point out, is within the sector. So a lot of movement within the sector. It was occurring last month as well, but obviously with this big move this month. So I show financials on a year-to-date basis. That is the worst performing sector. A lot of that driven by, I guess, two things. One, primary one is the private credit concerns. If it wasn't for this war in Iran, private credit would definitely be getting a lot more attention. It's still there. Potential problems are still out there, but not getting much attention because of the Iran war. But that was a big driver of why financials are down year to date. Started back in late January, but it's still hanging out there. And then there's the other driver too now with the higher interest rates. especially on the short end. Not as good for banks, when they, pay the savers a rate and then they borrow longer, but when that curve gets flatter, not as much profit margin for the banks. Two more lines here. So the next line I show looks like private credit. So again, I did mention this last month. I show it again because the brown line, it's the lowest one. I grabbed Blue Owl. Again, you could have grabbed KKR, Hollow Group, other ones, but these are publicly traded ETFs that capture the concerns of private credit. So it's now down 37% on just the year-to-date basis. And so looking at the graph, again, the first 2 months is what I talked about last month in this section, and it continued to go down further. Again, part of that is just, yes, the Iran war, things are pulling back, but it's pulling back more than the overall market. Those concerns are still out there. And then finally, I mentioned crypto earlier. When Bree put the table together and showed positive 3% for crypto, I knew it was stable, but it's like, it kind of surprised me that this graph captures. Again, it's still a volatile asset class, but a lot of the pain was inflicted that, by early March, I think it was like February 5th, the damage was done, at least so far, relatively speaking. So, for a pretty volatile month, going to a war, Bitcoin has been stable and, a little bit up for the month as it showed on the table. So, back in January, what was a driver? It appeared to be a lot of levered unwinding going on. And the fact that it's since stabled after that effect reinforces, for me anyway, that I do believe that was the case. And so it's a bright spot, if you will, for things holding steady and relatively stable in Bitcoin. I keep mentioning the Clarity Act. That still is not passed. Again, Iran war's taking a lot of oxygen out of the room right now. But there was, so the SEC and the CFTC, who are working much closer together now for regulations, they came out and provided clarity, no pun intended, some clarity on what is a security or not within the crypto space. And so that helped in terms of providing that clarity without getting the full Clarity Act. Pardon my pun there. So that is a summary of the equity markets and the couple of graphs that I like to show and geek out on. So thanks for coming along with me. The next graph that you're going to see on the screen now, let's talk bonds. And so speaking of geeking out, nothing says that like let's deep dive on bonds. So on the screen now, you'll see the usual bond yields going back for 1 year. And again, glad I have this 1 year time frame because you can now see some of the movements. Again, recall last month, I was talking about how low rates were. I was surprised, the 10-year was getting down to, I think, 3.97 at the end of the month, if I recall. So pretty extraordinary move to the downside last month. And so we had a low starting point this month. But again, with the Iran war, again, a lot driven by inflation concerns with energy, rates moved quite a bit. So you can see that on the graph now, pretty much across the curve as I'm looking at it. Yeah, the 2s, 5s, 10s, everything was moving up for the month. I guess specifically the 2-year moved, it went up in yield by 0.41, and the 10-year went up in yield by 0.33. So it's called a flattener from the front end, or a bear flattener, I guess, for the bond geeks out there. But that's what it was. Credit spreads also widened, but not as much as I would have thought. So again, kind of this whole flight to safety, which didn't quite happen. And then you think people would be running from credit, didn't quite happen as much as I would have thought. So part of that story was playing out starting in late January with the private credit concerns. And so it continued to widen, don't get me wrong, but on a year-to-date basis, we're only I say, but triple B, which is investment grade, is wider relative to the tights in January, only 19 basis points, which is 0.19%, pretty tight. And then the single B spreads, that's talking high yield territory, that was wider by 0.66. Take a look at the graph. I also show a 30-year graph in my blog post if you want to get a bigger, longer-term context. Now jumping over to the Federal Reserve. So there was a Federal Reserve meeting. It concluded on March 18th. No change in rates as expected. So current rate is still 3.5 to 3.75. So two things. One, the market was expecting that there would be maybe 3 voting members would dissent, meaning they wanted a cut. There was only one. So the Steve, I forget the name, but anyway, the Fed Governor Moran, I think, was a dissenter, but only him. We thought that we had a couple of others. We didn't. The other thing was the summary of economic projections was released. And there, that's usually the dot plot. Like what does the Fed think of where Fed funds rates will be by the end of the year? Not a big change there. In fact, the average rates didn't change at all. There was a bit of the range for 2026 tightened up, but otherwise not a big change there. But the biggest move was for 2026. Again, the numbers represent where they expect end of year rates to be for 2026, 27, and 28. The PCE, which is the Personal Consumer Expenditure Index, the preferred inflation gauge for the Federal Reserve, that went up by 0.3 from 2.4 last estimate, which would have been, I guess, December. This one is now up to 2.7. So what's the big deal, Kirk? It's only 0.3. Well, the big deal is the Fed's target on that is 2%. And so it's going up. And the market was kind of expecting the Fed was going to cut. So another data point where it might be kind of tough for the Fed to cut. So that was interesting to note. And then, don't take my word for the thoughts of if the Fed will cut or not. There's this thing called the Fed Funds Futures Market. It's as deep as the ocean, and it's telling you that they took that pricing away. So you'll see a graph on the screen now from the CME FedWatch tool. A great tool, highly recommended for everybody. I grabbed there's different graphs you can grab from that site. This particular one shows what is the probability over different ranges of the Fed funds rate. And I'm not sure when this all happened. Let's call it, before March. The market was pricing in at least a couple cuts. So going from 3.5, 3.75 down to rate cuts. Now, looking at the graph here on the screen, they were talking mid to late 2027 before the Fed funds futures pricing anyway is implying a cut or a potential hike. I doubt it, but there's a small chance of that happening. So anyway, pretty interesting move, major shift in Fed funds rate expectations. And that's going to drive, obviously, interest rates, but also equity markets. Higher rates don't bode as well for a present value discounting of cash flows. And so then finally, my special topic of the month. We're done talking about the markets. So this month, I decided to talk about the oil market. Now, I am not an oil market expert, so let me tamper your expectations there. But I wanted to point out two things that I find helpful or interesting. Hopefully you do too. So one, there are two major markets that are very different that you might hear in the news, very different prices. And so I guess stepping back, why do you care about oil prices? Because people use it, companies use it, energy costs. So it's going to increase the costs at the gas pump, just the cost of inflation. So you may hear these barrels of oil costs thrown around. There's two major markets. So one is the Brent crude market, and then also you might hear the WTI, the West Texas Intermediate market. So the Brent crude market is a global seaborne based market. So global seas, think Strait of Hormuz and the Iran war. So they're having trouble getting shipment going through there. So about 20% of that global market flows through there. So that is up much higher in price because that is the global seaborne market. The WTI, that's a US based benchmark. It's actually based down in Cushing, Oklahoma. So yes, those oil prices are up, but not nearly as much. And so if you hear prices being thrown around with the price of oil, make sure you remember, was that a Brent crude quote or a WTI quote? So that's one thing. The next thing is, it's like, well, crap, these prices are really high. We're going to be screwed for a while. The next thing is, well, how long do you expect these prices to be high? And one way to find out what the market thinks of that is, again, this futures market. So the CME group trades a lot of these commodity futures, and they have not only future markets for next month, but they got various months going down. So you'll see a graph on my screen now. I'm showing the WTI. So this is the U.S. inland market futures contracts for oil. So the front month, they call it. The first month is May of 2026. That's trading at 116. I grabbed these prices this morning. I'm recording this on April 7th. So I grabbed them sometime 9 or 10 o'clock this morning is what you see on the screen. So 116 for the front month. So that's there. It's very high. So it's like, holy cow, that's really bad stuff. But if you look down the row, you can see the June delivery drops down to 100. I'm rounding here. July down to 91. You get out to October and it's down to 77. So what the market is telling you is it's actually called, I guess, what is the term? It's backwardation. So the further out you go, the lower the price, which is not normal. It depends on the commodity, I should say, to clarify that. Anyway, the market is letting you know that they don't expect this to be a long-term problem, but it's still up and it's going higher. So if you want to get an idea of what the oil market is thinking and the impact on inflation long-term, this would be a gauge. Plenty of drivers, and I'm not an expert in this, but looking to see what those few months out contracts do. They were holding actually much lower, but they are starting to trickle up. And so worth watching to see what the market thinks of how long it will happen. So that is a summary of the action from March. Like I mentioned last month, I expected stuff to be coming, but I was recording it just through February last time. So here we saw what happened so far. There's plenty still going on. I was just, the screens today, the VIX, the volatility index is up in the 27s, 28s range. So that's high. So definitely there's a lot of uncertainty out there. And not many people quote the bond market volatility index, but that's also been elevated again, just with all these moves in the rates. And so anyway, take a look at things, know what you got. Yes, things are down, but just know what you got and stay diversified. And stay on top of it. Definitely, it's worth staying on top of it. It's not a broken record anymore. Things are going on. So, shout out to, I guess, the UCLA women's basketball team and the Michigan men's basketball team in college. So they're the NCAA champs after this weekend. Those who are fans of Eating Sunshine, myself included, happy hamper. Things are getting lighter and lighter as we go along in April, but damn those rain showers. So here we are in April, so just keep in mind those May flowers are coming soon. All right, that's a wrap on today's topic. Thanks. Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.